Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about inflation, jobs, and why, unfortunately, mortgage rates are rising. Logan, welcome back to the podcast.
It is wonderful to be here, and hopefully, I'm wearing my Niner stuff. It's Friday morning. It's right after the existing home sales report, and hopefully, I'm happy on Monday
when this airs. Yes. Otherwise, we'll be seeing you in your gear and saying, "Oh, that's so sad." So we'll have to see.
Yeah, I mean, we don't want to be the Cowboys. By the way, it is so great. You know what I loved about X when the Cowboys were getting thrashed by the Packers is that everyone on social media joined forces together to bash the Cowboys. People that hated each other on social media joined forces to bash the Cowboys, and it was just wonderful to watch.
It's the one thing that can bring our country together. That's terrible. Oh, okay. Well, we have a lot to talk about today. We're going to get to mortgage rates, but let's start with existing home sales.
Yes, existing home sales came out, and one of the things I was talking about in the last few weeks is that purchase application data started to have its positive run in November. And remember, this data line looks out 30 to 90 days. So I didn't think December was going to capture some of this. So we have a very low bar. Like how I explain this, when I went on CNBC yesterday, I said, everyone, let's be realistic here. We have the third calendar year of great recession lows in demand. Third calendar year, right? Existing home sales got a little bit below 4 million back then. We have 157 million people working. So we have the lowest bar ever. So let's put context in some of this demand coming up. Again, I believe rates need to go lower for longer to get this thing really going. But for now, we're going to get a little bit of a bounce. When it comes out, just keep it in context. And we created the tracker article to keep people in line of what's happening. So it's not surprising that existing home sales came down a little bit, but it just shows, what are we dealing with? Extremely low levels of demand, which is also a public policy choice as well. But in this context, when we see that sales start to rise, let's remember where we came from. This is not the COVID-19 recovery where, boom, we're going to get home sales unleashed again. And here's something, a good discussion for everyone to remember. A lot of people believe that if the Federal Reserve and the government didn't stimulate, home sales would not go up. Let me tell you, if you want to, again, pull out your amateur rookie housing card, you do this, right? So existing home sales broke out before COVID-19 hit us, right? Purchase application data hit pre-cycle highs going all the way up to March 18th, 2020. Existing home sales had a pre-cycle high print before COVID hit us. That means the level of sales was up and then the inventory level broke. So with lower rates, you get more buying power, but the demand was already there. The one variable that changed was inventory broke to all-time lows. And we have over 153. There is so many bad housing takes that, again, part of the reason we do the Nurture is to explain to people, right? Economics and demographics. We have a lot of people that certain groups of people buy homes, affordability runs it. So we're working from a very low bar right now because in January of 2020, the existing home sales print was almost 5.8 million. Here we're 3.78 million. So we have a very deep collapse in demand. Inventory is still very low. The NAR data is back down to 1 million active inventory. The peak in 2007 was 4 million. So when rates do fall, demand picks up a little bit and we work off the equilibrium off there. And it's not going to be like COVID where we just shoot right back up. Even with the purchase application data, it's not showing anything like that. But small steps, we'll work our way there and we'll take it 1 week at a time. But context is key. You have to, where you're coming from matters.
I think that's so important because it feels like every time we have a change in economics or something's happening, people go to the last cycle or the one before that. So it's either 2008 or it's something from COVID. And, everything is very unique. And in this cycle, especially, we're coming off of that COVID stuff, but it's different.
It is. I just also, again, we're laughing because John Burns Real Estate, which is a great company, Irvine, California, too. They're laughing that, the Wall Street bought 44% of the homes. in 2023, and it was 1%, of all sales. Just keep things simple when you think about housing. Rent, date, mate, get married, have kids. Younger people buy homes if they can qualify, especially if you do at a certain age. And then you have the move up buyer, move down buyer, cash buyer investors. You put them all together. There's your buying group. Wall Street is very tiny. iBuyers are very tiny. And that group, a lot of that revolves around affordability. Affordability got shot. This was the whole savagely unhealthy housing market theme, that inventory broke to a level we've never seen before. We have too many people chasing too few homes. So that affordability index getting shot matters because there's no more exotic loan debt structures anymore, right? We had mortgage rates between 3.25% and 5% in the last decade, right? We never had escalating home sales or home prices escalating because inventory was kept things stable. Here it's different. And the days on market today in the NAR report, 29 days, for me is like, I feel so much comfortable if we're like 30 to 45 days. But the days on market is also seasonal as well, right? So it, falls in the spring and then bottoms out and then rises. And we don't have a lot of product out there. So hopefully now that we're seeing the new listings data grow, even with higher rates, Sarah Wheeler, last year with 8% mortgage rates, we actually saw new listings that we're seeing new listings data grow year over year. This is one of the things I talked about on CNBC. So this is a positive. Again, most sellers are buyers. Are there stressed sellers out there? Of course, because people lose their jobs every single month. But in general terms, it's a positive to see we're getting more new listings, not the silver tsunami, but this is the way to get back to a normal housing market is to get active inventory, new listings back to somewhere normal. What happened after July of 2022 all the way up to 2023, which is historically low, you don't have a functioning market in that regard.
What do you always say? The best way to fight inflation is with supply, right?
Yes, the best. Yes, it's and being part of team higher rates. People always say, "Well, you were team higher rates in 2021 and 20." Yeah, because again, I'm not trying to knock people down, but everyone is going to do anything in their best self-interest, right? So let's all remember what housing was in 2021. Everyone was YouTubing and high-fiving and, oh my God, I got 50 offers and everything, because you are celebrating this great victory for your seller. And you got buyers out here, 50 people buying on one home. The only way to check that, because we can't check credit channels, you needed higher rates to cool it down, because I don't trust all of you. You're going to do what humans do. You're going to do whatever you can to make the most money possible, right? So we needed high rates. Now, rates got very sloppy, getting to 7 to 8%. Rates are still somewhat sloppy in that area, but checks and balances in housing is much different. And the Federal Reserve doesn't really revolve its general policy around housing. They're kind of being very coy right now because of the labor market. And guess what data line broke under 200,000 again? Headline jobless claims, right? So what do? We do this paper, rock, scissors game, inflation or labor data, right? So we always go fists over scissors, labor data over inflation. Inflation falling is so key. It is the baseline of everything that we think can be positive, right? Even for like the soft landing. But the 10-year yield right now is just going to really revolve around labor data. If jobless claims were at 300,000 and we're about to like break through my recession level, the 10-year yield will go down, because what we saw this action toward the end of 2022, the bond market assumed that the world economies were going to force a recessionary data line, was going to force the Fed to pivot. It didn't happen. Even at the peak of the financial banking crisis, the 10-year yield on one day broke that Gandalf line, because it's doing what the bond market does. The bond market sees this as, okay, the Fed's going to have to cut rates, inflation. It didn't happen. So the 10-year yield is, again, almost at 4.25. That's the peak call of this year. 7.25 mortgage rates is the peak call. But even if we get 4.25 on the 10-year yield, I don't think we're going to get 7.25, because the spreads are better, right? That's another thing that I always try to remind people. We wouldn't have 8% mortgage rates last year if the spreads didn't get bad. So the spreads are actually problematic in this sense. And we do hear rumors about things that are in the works to try to help with the spreads. But labor data is still solid. I think one of the frustrating things I see is that people listen to all these, oh, well, multiple jobs, and the labor market is softening. It's not breaking. Softening and breaking are different things. Hours worked is getting less. There's some companies that are overstaffed or labor hoarding, but the whole labor hoarding thing was, God, the baby boomers are leaving, guys, right? The whole job openings, 10 million, was the baby boomers are leaving. And if you replace them, it's a wash. So if demand grows, the need for labor is more now than, let's say, after 2008, when job openings were at 2 million. So structurally, again, the demographics of America are different now than they were back then. And now we see it, more and more companies thinking, oh, we're hoarding our labor because we don't want to like rehire people. So there are some companies that are anticipating a better economy. The Michigan index actually rose this morning very noticeably. So companies are a little bit more mindful that if I let this person go, can I hire another person quickly? And you do. Everyone's a little bit more mindful of that this time around because robots did not take all the jobs, Sarah. They never
Robots didn't, but AI is coming for some jobs. I think we are going to see that, in the next couple of years, depending on what that job is. That's
we saw this movie once. Skynet wins no matter what. Skynet wins no matter what we do.
We need to find our John Connor right now. Okay, well, let's dig in a little bit on rates because I understand everything you just said about labor. I understand, but it's disappointing that rates are headed back up towards 7.
Here's the thing: if you look at technically on the 10-year yield, okay, so I know charts and technical things aren't anything, but we had such a huge drop that the 10-year yield got all the way down to 380. Now that is actually really important. We bounced off 380 for a reason. And that 4.25, if you kind of look at that, there might be a head and shoulders with a Gandalf hat, forming. But it's rising for the reasons that we always talked about, labor over inflation. So the inflation data, Sarah, we are going to have like 3 to 6 month inflation, core PCE running below 2%. We're actually below. So what happens? Of course, we have Fed presidents talking about, oh, maybe we don't cut rates as fast as people want, So again, this is a policy choice, right? You have to, if you're playing poker, you're playing the people, and you're playing people that are worried about their legacy. Like, imagine if Logan took over all the Feds and I got them all out, kicked them all out right there. I'm saying, hey, guess what? We're cutting rates 75 basis points because we overhiked, right? We want to keep the Fed funds rate and core PCE, and we need people to buy homes again, right? Home sales have the 3rd calendar year. This is the one thing. Why? Because a functioning country, a country that prospers, right? Rent, date, mate, get married, have kids, have sex, buy homes. This is how this all works, right? I'm not letting the old linger with joy, baby boomers, while the young have to suffer. So we're not talking about cutting rates to 0 or anything, but you're going to need the 10-year yield, or you need mortgage rates to get a little bit of growth. Because again, 3rd calendar year of great financial recession lows in housing, and the Fed is. It's a policy choice. It's for a reason, right? And if you don't remember, like I've always said, you go back to last February and 6% mortgage rates. All of you people that are listening to this, you made the Fed's life difficult. How are they supposed to defeat the 1970s inflation if you guys are having sex and having kids and buying homes and moving? Oh my God, you're actually providing stuff to the economy. So at one point that does change, but to me, they're working off labor data more than inflation. And clearly we can see it now. It's 2024, 10-year yield's almost at 4.25, right? The growth rate of inflation, we're going to have core PCE get below 2% on the 3 to 6 month levels. We're already even below the Fed's target on that. And they're talking about, we might not cut rates. You better watch out, man. Waller was like, hey, it's not supply that drove inflation. Look at the CPI. Look at the Fred data.
So if you're, for all those people who are out there, they're mortgage lenders, they are LOs, they are real estate people. We were excited about 2024 because it's like some relief is coming for the buyers, which, lubricates the whole system, makes it all work. What do you think? What is, I know what your range is, but like, What's
It
going
looks
on?
normal. See, this is why I say it looks normal to the range, right? So I say labor over. Here's the frustrating. I think a lot of LOs are getting bad information on the labor market, right? I think what I see is people like saying multiple jobs are growing. The labor market isn't. Guys, labor market breaking is jobless claims. Okay, I'm not saying that one data line over and over again for all of your health. I'm saying that the Fed and the bond market will move on that. Job growth is slowing as it is, but we stay in this range. We already had such a big move. Unfortunately, that big move came when the 10-year was at 5% all the way down to 380. I would prefer that to be like 425 down to 337, and if the spreads get better, the spreads are getting better, but then you could get down to the low sixes with keeping still the channel intact. But also you got to remember, global bond yields play into this. This is not like the last decade where, we had so many other countries with even negative yields. So it's just a different marketplace. It's frustrating. I get it. We do what we can to kind of like bash the Fed and talk them into maybe, loosening up, but it's early in the year. And again, this is why we track labor data, jobless claims every week. And you could see what happened. The Fed felt a little bit uncomfortable with the 10-year again at 3, and they don't need to. They just choose to do this. So this is who they are. Play the poker game with the guy and the lady you're playing. And they're not. This is why I said the Fed didn't pivoted, right? If the Fed pivoted, we'd have a whole different topic. But bond yields are here still. Mortgage rates are still near 7. And the core PCE 3 to 6 month is about to break under 2%, below their target. So play the man in that game of poker.
And unfortunately here, it's the Fed, and that's who we're stuck with. Okay, so what do you see coming up as far as, you said there are some things, some rumors about like how the spreads could get better. What does that look like? What are the things that could do that?
They're talking about maybe Freddie and Fannie buying MBS, right? So, I mean, they're in conservatorship. Like if I was the US government, because the growth rate of inflation, I'm already implementing something like this just to get the spreads. Like if the spreads just get better, we're talking about 6% mortgage rates. And this is not 3.25% to 5%. This is something just to get things a little bit going. What you don't want to do is a home buyer tax credit. Did you know, Sarah, that I hated the the first time home buyer tax credit so much? It was one of the reasons I wanted to write. I thought that
I
was
did
such
not know that.
Yeah, that was like when I saw that plan being introduced, I'm like, oh my God, I got to write about housing. This is
Well, I
just,
do remember we had a conversation because you were like, all that will do is make things worse. That
it's
was
just
your.
forwarding it. Oh my God. You think about, do you know how many investors love that? Back then, they had all these homes they bought in foreclosure box, and they're selling them to mortgage buyers. They front loaded the demand. Demand went up to like 5.4 million, and then existing home sales collapsed. All you're doing is forwarding demand to one period, and investors made a killing off of that. I'm not a fan of that. I understand, there's programs out there to help first-time home buyers, but when you label a plan and you front load it with a time, all it does is forward demand to one thing, and then we saw a crash in demand, and really nothing happened out there. So providing a better mortgage-backed security market is actually more beneficial because it impacts the whole, not just one designated group of buyers. So again, you just need lower rates for longer, right, to get this thing going. So we're having growth in purchase application data. It's just nothing really big, but we can grow sales this year as new listings data grow, more sellers or buyers. Again, people have to live, and that's the thing. It's just that COVID is over. The 1970s are over. You got to let things go, and you got to live. And this is why when you have too many older people in charge and you have politicians that don't want to give up their, power, and as they get older, it gets harder to get them out, and you get stuck in a certain way. This is why I always think it's very good for having younger people into the discussion because they can relate to younger people as much. And it's going to be an interesting year, but so far everything kind of jobless claims broke under 200,000. The 10-year. I mean, if we didn't have this discussion on the growth rate of inflation falling, the 10-year yield could be at 5% today. We could have 8% mortgage rates, right? Because the labor market has to break. The labor market doesn't have to break. So I know everyone's mad that, rates went back up, but think about it. If we didn't have the growth rate of inflation falling, we're doing we have to break the labor market to bring down inflation, 5% 10-year yield. So again, this is a public policy choice by the Federal Reserve and everything. Growth rate of inflation fell without a job loss or recession. Land the plane. Just land it. Get rates a little bit lower. Get people a little buying. That's it. Everything else will kind of work itself off on the economy.
Wow. Okay. Well, I want to preview something we're doing this week. When this goes live, it's Monday. This is Housing Week. So HousingWire is having a Housing Week, and it features you. And Housing Week is really to a showcase of the data we have, the insight, the analysis, the amazing events we do. And so every day we're doing something different for people who are subscribers. So if you're not a subscriber, first of all, you should be, just to be able to access what Logan does every week on the tracker, and then all the different reports he writes up. But this week especially, we're having a different event every day. The first one is, hey, we're going to showcase our data. The second one is featuring a webinar with Mike Simonson, who is the founder of Altos Research, the amazing data that Logan uses for his tracker. On day 3, I am doing mediating or being the moderator for a webinar about the LO comp practice that might be illegal. That's going to be amazing. And then on day 4, we're going to have you, Logan, be the detective, not the troll, a webinar just for our subscribers. And then the latest on the commission lawsuits on Friday, which I'm also moderating between Michael Ketchmark and Anthony Lamacchia. Huge. We have thousands of people already signed up for that. So this is an incredible week. And, Logan, you are one of the people that, we showcase because your stuff, you can't get it anywhere else. So people have to subscribe, right?
Yeah. Again, my job is just to connect the dots, right? I'm not going to abandon all of you. People give a forecast and then you don't hear from them. We're going to hold everyone's hand and walk through this day in and day out, because I don't do anything else but this. And again, my job is to teach economics. If you teach economics, then you won't fall for the 44% of Wall Street bought homes last year. Just get 3 million views on some fake. By the way, the final numbers came out on that for 2023. We had roughly almost about 4.1 million home sales. So again, even with 8% mortgage rates, total home sales were actually near 5 million with the new home sales added. But it was 1%, like 1%. All this smoke and jazz about 44% of homes. Again, class warfare. Remember, the Russians have figured us out. You can do disinformation campaigns in America through many different social media sites. I know, because I've had to battle with them. But when you have American citizens doing this, domestic Russian interference work of disinformation, that's war, guys. That's why the academic people have to fight back against disinformation campaigns, right? You have to go after you can't let these people just go around and say stuff, because people will believe them, right? And then you have all these crazy views out there, and reading has gone down, Sarah. Reading has gone down, and we're fighting a war that we're losing the battle. So tactics have to change. So this version of Logan has to be a little bit more theatrical and social media and everything, and challenge people to live debates. But we're just here to give you the data, and it goes with whether it's positive or negative. It does not matter. We don't have a bias. People say you're very biased, you're very pro-America. You're damn right, I'm very pro-America. But if the data turns negative, we go with it. If the data goes positive, but we keep it in the realm of reality. And I know economics done right is boring. I'm trying to make it as entertaining as possible, so you all have real information. Out there, it's trash, man. It is some crazy stuff out there, and I just think generally the academic world does not like X, does not like social media. They don't like to engage people. Me, on the other hand, every single day, I would line these people up in a live debate, piece by piece, right? And at least we're trying to get this conversation out. And my version is just to show the data and keep everything in line. Because now that we're in 2024, guys, I'm telling you, follow the historical partial works, and we just go with it. And this is how it's been since the Peloponnesian War, right? And we just go with that every single week. That's why the tracker is created. So we keep everybody in line, because nothing stays static. Things can get better, things can get worse, but you're ahead of the curve more than anyone else.
Logan, appreciate that. And I will say, yes, you are pro-American. You are bullish on American. on America, but you are not, what do they call you? A perma bull? I mean, you'll look at the data and you'll say, this is where the data is going.
Anybody who has models cannot be a perma anything. That's rule number one. This is why I'm always saying I want forecasts and I want models. I want live debates with all those YouTubers and TikTokers and Instagrams and X people. And then when you get them on stage, face to face, and then you have to destroy people on camera. And then, I don't have a model. I don't have it for really. You're kidding. This is the person you listen to, right? So I would say that this is a clan. This is a very clan-like activity. It's been happening for centuries, right? We have a version of our own here in America. So you have to go after it, but you have to do it in name and face, because I want their kids and spouses and coworkers and everybody to see them for who they are, because they won't change. They will be like this until they die. So that person and I, we're going to die and go on in the afterlife, but they're going to be in that group. I've always said, we've always had this group of bearish American citizen. The graveyard is deep and it went below the devil's den, and we're adding people to it. At some point in the future, something will happen. But again, let me tell you, we want to add more people to this. Cycles come and go. We have models for this. They don't.
Well, we appreciate you. We will look forward to your webinar this week and some more articles coming out this week. Logan, thank you as always.
Pleasure as always.